4E, personal income taxes. In this section, we'll talk about how taxes work, how taxes related to one person or one family. When we deal with income taxes, first we have to calculate the total income. And the total income pretty much includes all sorts of money that you make that you think you'll be making. And the government wants a piece of that. They want tax on everything, essentially. So if you get paid from a boss, government wants tax. If you make some sales and you make some money from commissions, the government wants tax. When you retire and you have pension money coming in, the government wants tax. If you run your job, if your job is more like a personal business, so for example, you might be an electrician, a plumber, or you run like gardening services, and you run it like a business, the profit that you make counts as income. And all sorts of investment that we might be making, whether I save money in the bank, whether I have an apartment that I rent out for income, or if I buy some bonds, or if I own a piece of a company as a shareholder, the company might be paying me a little bit of the money that they make. That's called dividends. Or if I sold a piece of a company and I make a little bit of money on that, that's called capital gains. And all of these count as income. So pretty much every single dollar that you get, the government wants a piece of it, and they count as total income. However, there are certain money that we can subtract from our income, certain type of money that we can subtract from our total income. So in Canada, to encourage people to save up for retirement, if you make some money and you put them aside, in a special account, and you promise to not touch those money until you retire, the government will say, fine, you're saving this for the future, let's not count it as your income. So the total income will be reduced, will be lower by however much you save up for the future. And typically, if you have a pension plan, so your company has a pension plan where they take a little bit of your money away and they put it aside for your pension, those money wouldn't be counted as income. They will be subtracted from your income. If you don't have a pension plan, that's okay. In Canada, we have something called RRSP, Registered Retirement Saving Plan. And this allows you to put money in this special account. And once you put it in there, it's a little bit troublesome to get the money back out because the government wants to collect tax. But when you put it inside, you sort of make a promise that, oh, I'm not going to use it. And so the government says, fine, we won't tax you on those money. If you have some investment, let's say you bought a building to rent out. Now, when you buy a building, you might not pay for the whole thing yourself. You might borrow money from people. So the money that you borrow from people, the interest that comes with that, they can be subtracted. Sometimes your job involves you to pay some union or professional dues. So for example, if you are delivering mail, if you're a postman, they have a union. And union are people who work in that job. They decide to join up and negotiate with the boss for how much we get paid, how much vacation we have. And then if somebody gets fired illegally, then the union will hire lawyers to fight on the employee's behalf. Now, to pay that into a union, sometimes in order to become a postman, you have to be part of their union. So you have to pay a certain fee. These type of fees are reduced from your income. Some job, like being a teacher or being an accountant or being a doctor, they require you to pay money to like the teacher society, the accountants association, for them to give you a license to make sure that you are doing your job. You are sort of up to date and you can do your job properly. Those are called professional dues. They are also subtracted from your income. Let's look at an example. Karina over here makes some money. All right, so that's income. She got more from a savings account as interest. So that's also income. So we add these two numbers up. But Karina might have a really good job. He might be an accountant. He might be a dentist. She might be a dentist. And she had to pay $1,200 every year to keep her license. So that's subtracted from her income. And she still makes quite a bit of money. So what she ended up doing is she said, I don't need to use all that money today. I'm going to save up $14,250 for retirement. And this particular place that she put her money to allows her to pay her tax later on in the future. So she doesn't have to pay tax on the $14,250. So we subtract that from her income, and her taxable income, the one that she actually had to pay taxes on, is just $33,900. Now, most of the North America and in Europe, we have something called the progressive income system. And what that means is people who make a lot more money, they pay income tax at a higher rate. And you notice how we have different rates, and different rates are called different. We call these different marginal tax rates. And usually, when we ask you what is your marginal tax rate, that refers to the highest rate that you are paying. And the reason why is, let's say I make $70,000. $70,000 is my income. So what happens is my $70,000 is going to be taxed at different amount, at different tax rate. Okay, so first thing that you had to understand is 70,000 is in this bracket over here, right? It's in here. But I'm not going to pay 28.2% for all 70,000. That's not fair. That's not fair. Because somebody might be making a little bit less and they get a lower rate for all their money. That doesn't make any sense. So what's going to happen is we're going to divide the $70,000 into different parts. We're going to take the first 45654. We're going to take this amount, and I'm going to pay 20% on this amount. Okay, so the first $45654 that I make, I'm going to pay 20%. The next little bit, and we had to figure out how much is that next little bit. So let's call out our calculator over here. We want 53359 minus 45654. So that's 7705. So the next part, I spread the next 7705. Okay, so I split my 70,000 up into these different portions, into 3 parts. The second part, the middle part that's worth 7,705. It has a special tax rate. It has a different tax rate, a little bit higher, 22.7. And then the rest of my money, anything that's over 53359, so the other, say $16,641. So the leftover amount, okay, the amount that's above 53359, you'll notice they add up to 70,000. I have to pay this tax rate. So I separate the 70,000 into 3 components, and I pay different tax rate at each of these components. So that's what we do. Now, my marginal tax rate in this case is 28%. That's the marginal tax rate. And the reason is because if I choose to make $1,000 more, how much tax do I have to pay on that $1,000? Well, I have to pay 28.2%. So that's the more interesting tax rate, and we call that the marginal tax rate. What happens if you make a little bit more, or if you choose to make a little bit less, right? If I choose to not work so much overtime and make $1,000, $2,000 less, I would save on 28.2% tax. Okay, let's look at a slightly different example. We have Portia over here. Portia has an income of $65,000. So we divide her income into 3 separate sections. The first 45654, anywhere between these 2 numbers. And we're not going to use 91 for the 3rd section because she didn't make 91,000, right? She make only 65. So we use 65 to subtract 53. And there are 3 different tax rates. Remember to change the percentages into decimal form, and you calculate each part separately, and you can add them up. So she has to pay 14,189. So in this case, her tax rate is not really 20.06. It's not 22.7. It's not 28.2. It's a combination of those. But we know in her case, she had to pay this much tax, 14,189.99. So if I divide these 2 numbers, I can find out what her tax rate is, right? I can find out what her tax rate is. Her tax rate, effective tax rate, is 21.8%. That's actually the average rate that she's paying, right? In effect, the 14,189.99 is 21%, 21.8% of how much she makes. And once again, marginal rate is pretty much the highest bracket that she got up to. And in this case, that's 28.2. So typically, we have something else that help us save tax. We have something called the tax credit. Tax credit allows you to lower the tax that you have to pay. So in the case of Portia has to pay 14,189.9. But let's say she has a tax credit of $1,000. Well, she can pay $1,000 less. She doesn't have to pay 14,000. She only has to pay 13,000 if she has $1,000 of tax credit. And tax credit can be things that we spend on different items that the government allows you to say, you don't have to pay. Well, you spend money on these things. Those are good for you. Let's not charge tax on you. Let's try to make you save tax. And one of the things that you can save is save on tax is the tuition, education, and textbook amount. So in Canada, we have something like that. So if you are in Canada, if you're learning, you're paying tuition, you will have these amounts that save up so that when you start working and when you first have to pay tax, the government says, oh yeah, you did make these money this year, but remember the previous years where you had to go to school and pay for tuition? Yeah, so the government says, yeah, don't worry about the tax, okay? We'll lower the tax a little bit for you, and they'll give you some tax credit. Now, when you're working, there's some deduction called CPP and EI, and we make these deductions because the government wants to take some money to use for government pension, and there's some for EI, like in case you get hurt at work, or if you want to go on maternity leave, if you have a baby and you want to go on maternity leave, the government, the insurance, the government-owned employment insurance will pay you a little bit of money. Now, these are taken off our paycheck automatically. So the government says, since that we take these money off, you don't have to pay tax on those. All right, the government is really nice and say, wow, we don't have to pay tax on the CPP and EI that we just that got taken off our paycheck. And finally, if you have medical expenses, that goes over 3% of your income, or about $2,500, the exact amount is 24 something. It's not very important. Let's say you have to go see a doctor, you have to go see a dentist, you have to go through a very special treatment that costs you a lot of money. The government says, don't worry. Okay, we won't have you pay tax on it. You save on tax. Now, the reason why we have these tax credits instead of just taking the money off from your taxable income is this. Typically, people who have a high marginal tax rate. So for example, if we have a marginal tax rate of 28.2%, if the government says, okay, let's count your income $1,000 more, you're like, oh, $1,000, and I save on 28.2% of tax rate. So I save 282. But if you make less money, if you only make $40,000 and the government says, oh, let's count your income $1,000 less, then you don't save 282, you only save $200 because you have a lower tax rate. So what the government do instead is they try to give everyone tax credit, so everybody gets the same amount. It doesn't matter what your marginal tax rate is. And this makes it more fair, or at least more fair in the eye of certain people. Okay. There are two types of tax credit. One is called non-refundable. So typically these are non-refundable. So what that means is if you happen to pay no tax, so right now, let's say you come to school and you pay lots of tuition, you don't have to pay tax. Now the government is not going to give you extra money for going to school. Okay, so the government will not give you tax credit and pay it out in tax. The government will say the one that you can't use up, you can either use it in future years, or you could, or it's gone. There's something called refundable tax credit, and the sales tax credit, like GST, PST, we have sales tax credit, and we also have climate tax credit, so the carbon tax credit. And these ones are refundable. So even if you come to school and you're not working, you don't make any money, if you file a tax return, you will get these tax credit back because everybody go out and pay these taxes. And the government says, if you just, because everybody has to spend money to get the food that they need to survive. So when you pay tax on it, the government says, oh, let's give you back the tax so it's easier for people with low income. Those are refundable tax credits. And that's one of the advantages of filing a tax return, even though you don't have to pay tax. And the reason is because you might get tax credit refunded to you. You might get a little bit of money back. Okay, so let's say Lewis has a tax bill of $5,000, but he has tax credit of $7,200. So his actual tax that he has to pay is $5,000 minus $7,200. It's a negative number. But notice how his tax credit are non-refundable. So the government is not going to give him $2,000 and $200 in refund. So what's going to happen is he doesn't have to pay tax and he doesn't get any refund. His tax bill is zero. So we talk about how tax deduction works. Tax deduction lowers your tax, and And pretty much you get not just the you don't get the amount, you don't get to save $500 like the tax credit. When we do a deduction of $500, we take $500 off your income. And that's not the tax you save, right? Because it depends on your tax rate. So the amount of money you save depends on your marginal tax rate. It depends on your tax bracket. So we take, in this case, 500 times 20%, that's only $100. So the nice thing about tax deduction is that if you earn a lot of money, it can save a lot of tax. But if you don't earn a lot of money, you don't save a lot of tax. So for the retirement saving vehicle, like the RRSP, it's very beneficial for people who have a high tax bracket because they can save a lot of tax. But if you're not making a lot of money, RRSP or retirement saving plan, those are not for you because you don't save a lot of money. In the United States, if you donate to charity, it's a tax deduction. In Canada, it's a little bit different. In Canada, if you donate to charity, you get tax credit. So everyone gets the same saving. And you notice in this case, when we are doing tax deduction, what happens is if Martin is in the 37% and Peyton is in 12%, Peyton only saved 1,000 times 12% because that's his tax rate. So he saved $120 on tax because $1,000 he would normally have to pay $120 on tax. So he donated $1,000, but he saved $100 on tax. So he got $120 saved somewhere else. So he really only paid $880. In Marion's case, his tax rate is a lot higher, 37%. So he saved a lot more. He saved $370. So he saved a lot more. He only donated $630. It only cost him $630, even though he donated $1,000. So that's why rich people in the United States like to donate money. The donation that they make is actually less than what it seems to be, right? For somebody who donated $1 million but have a tax bracket of 37%, they're really only donating $630,000 because they save a lot of tax. And the same idea applies to tax deferred saving plans, RSPs. So let's say we have $6,500 and we want to put $500 in the tax saving plan. So what happens is our income gets reduced by $500. So instead of $65,000, our taxable income is $500 less. It's only $64,500. Now we're not going to do a calculation of $65,000 and find out how much tax, and do a calculation of $64,500, find out how much tax, and find out how much saving is. That's way too much work. So what we're going to do is we're going to figure out that we are saving $500 of tax that we have, saving $500 on income. And the income that we are saving is in this tax bracket, right? When I go from 65,000 to 64,500, the extra 500 is going to be taxed at 28%. So the $500 is originally going to be taxed at 28.2%. So originally we had to pay $141 when you make that $500. Now the government says, oh, we're going to pretend that you never made the $500. We're going to pretend that you made $500 less. So we don't have to pay $141 of tax. We pay less tax.